A very special guest joins me in this episode of the Marketing, Business and Wealth podcast, a self-made millionaire in his 20s, starting from scratch, also building an accounting firm from 2 to 33 employees and multi-seven figures in revenue, also from scratch in his 20s, a property investment portfolio of 12 properties and counting, and also owns a steel manufacturing business. I caught up with Gary Brown on Zoom, and we'll head over to the recording of that conversation on this episode of the Marketing, Business and Wealth podcast. Gary Brown, welcome to the Marketing, Business and Wealth podcast.
Thanks, Az, for that amazing introduction, and thank you all for listening.
To start off with, you're in a unique position for a man that's just turned 30. You don't need to work. Yet everywhere I look, you seem to be doubling down, going harder, and be more driven than ever. What's driving this output at the moment?
I think it goes back to the purpose. When you are motivated to achieve something, it becomes easy. And for me, one of my core motivations is to empower business owners to understand the numbers better. And you can only do so much of that on a one-on-one basis. So going back to my roots of doing content, doing more public speaking, trying to impact more people's lives is just something that I'm pretty passionate about. And because of that, I just want to do more of it. So I really feel like it's a task or a challenge. I just enjoy doing it. So I'm just going out there and getting it done.
Yeah, it's interesting because you get to a certain point, I guess you can speak to this perfectly, where you achieve X in your professional career, and then you kind of ask the question, what's next or what's bigger than this? And it sounds like you know what that is already.
In every business that everyone probably does, they get to a point where they're comfortable, and you have two options. You can either stay in that comfortable area or you can continue to challenge yourself. And for me, in this context, I decided that we'll still grow our accounting firm, but we're going to pull different levers to grow it. And I'm going to focus on some other things and focus on the clients that I deal with. But we're also going to grow the accounting firm by showcasing other people's talents, other team members' talents and their skills, not always my talents. So I think at a certain point in time, you can get to that comfortable level, just ease it all up and take a holiday for a couple of years effectively in the business, or you can find a new way to challenge yourself, to challenge your team and push forward.
I think that's a beautiful segue because I'm looking at the Hatcher journey, which we're going to take the listeners through right now. So you started that business as you with yourself and your lovely wife, Jenny, just the two of you. And by the age of 30, you built that up to 33 employees in a very small time frame. So I guess my first question is, why did you do it? Why did you start the company?
To anyone that I previously worked with as an employee, I don't mean to be any way disrespectful, but I did see a gap in the market of how I believed that accounting firms should operate, how I thought that the business owners were crying out for something more than just a compliance only tax return, sometimes 18 months past when the data was historically finished. So because of that reason, I was probably bugging my business partner, my wife now, but back then bugging my coworker Jenny, and we're sitting next to each other, and I was probably bugging her for years. That's how much I whittled her down and got her to convince her that it was a good idea. And eventually I convinced her and we went off on this journey, but it was because there was a gap and I felt that we would be well suited to support and transform people's views of what accountants are and how accountants should communicate with their clients. Because I go into partnership now with pretty much all my clients that I work with because it's in my best interest to help them grow, not just from a personal standpoint, but from a business and wealth standpoint, because the more they grow, the more they help me grow. And so I've always viewed it as a partnership.
Yeah, did you always have that, I guess, wiring to go into business? Was it something from a young age you thought, I'm going to go into business one day?
Definitely was. So one of the things that I'm very grateful for was my mother. She always used to drag me along to any type of seminar that it related around property or business that she went to, and I always got dragged along to them. And I'd be really upset at the motion of going from Torquay, Geelong up to Melbourne to listen to some random guy or girl speak. And eventually enough of that sank in that it's probably something I always knew I was going to do was to be a business owner. Once you work that out and you have an understanding that's what you want to be, then you have a goal. And once you have that goal, you can go out and achieve it.
Amazing. And when you started out, what was one of the biggest lessons that you learned
Yeah.
taking that leap from working in an accounting firm into starting your own accounting firm?
Probably the biggest one, and which is why I harp on it so much with other people. But when we first started our accounting firm about 7 years ago now, there was actually three partners. And that worked really, really well because then there was only two partners after 3 months. In that context, it was quite challenging to exit the third partner because he wasn't living up to the standards that we had agreed to and set because we didn't have a partnership agreement or a shareholders agreement. That caused a lot of complications that it probably didn't need to. And knowing what I know now, every single time I hear people want to go into partnership together, obviously getting the structure right, but also getting the legal documents correct is the most important. And I've seen it time and time again where spending $5,000 at the start might sound like a lot of money with legal documents, but further down the track would have saved people tens of thousands in legal fees and time, energy, and effort.
Yeah, I think that's great advice. A lot of people kind of go into business on a whim, but they don't consider structures, how they're going to set up, the implications of that particular structure, which we're actually going to dive into a little bit when we get into some of the tips and ideas for business owners. So, in that initial building phase, in the first, let's call it 12 to 24 months, how did you start building your client base?
At the start, we had no clients. So one of the things was that I was very big on, and also Jenny was very big on, that we didn't want to take any clients from any of the accounting firms that we previously worked at. So we had to literally start off with zero clients. That was obviously pretty scary, and each to their own when they're doing this. But because we had that mentality on day one, it was like, gotta go get some clients. How am I going to get some clients? First, start off with friends and families, and you pull out the fillers. Who do you know who may be interested in, who needs individual tax returns done, all that type of stuff. And family are normally willing to support and help, and they were great. And my family have been amazing in that sense. But then the real challenge comes when you get past that first friends and family section. And for me, what I did was I signed up to a company called OneFlare. And OneFlare was a system, I think it's still around today, where people would post that they need an accountant, and then you would technically buy the lead for 10 or $5 or $10. And you just get a number. So I called over the next, from start of business to about 18 months, we bought about 1,200 leads, and some of them were individual tax returns. Some of them would have been businesses, bookkeeping, all that type of stuff. So over the first 18 months, we bought around 1,200 leads, if that makes sense. And I had a joyful time of calling those leads multiple times to try to convert them. So I did a crash course in sales, had to learn how to do that even for a $50 tax return. My objective was to win that tax return job, get it in, get it out, even if it was a $50 one. And that's how we first built the first $200,000-$300,000 in accounting fees, which is a funny way to do it. And still to this day, we have clients that were from that original calling, and they've been with us for multiple years, and it's been amazing. Highly recommended to do something like that when you've got heaps of time. Where for me, at that end of that 18 months, I no longer had that time to spend 10 or 15 hours a week calling these random numbers up. So it didn't work after that, but at the start, it definitely did.
So you're in the trenches making phone calls, which to be honest, most of the business owners I know that have built successful companies, that's how they started. They were on the phones, they were hustling, they were making the phone calls. A lot of people avoid that activity when they're building from the ground up, yet it's one of the paths that will set you free, and having that skill set is invaluable moving forward. at what point did you start introducing team and start to scale and bring in other employees to start taking over some of that load?
That's the hardest part of business, is when to pull the trigger on that team members. We made that decision around probably 7 or 8 months of business, that I was already working 60 hours a week, and I knew we had enough new clients, and I knew somehow, I don't know how, but I knew somehow we would have enough to make it all work. So that's when we pulled the trigger, and we got one of our friends to come in, Melody, and she helped support us. She just come back from maternity leave, and she helped support us for, I think, 2 years after that. So she was a fantastic asset in that sense. But you got to have that confidence, or that underlying belief that it's all going to work out. And that first team member is the hardest, but if you get it right, then you can continue to work on the tools, or you can continue to grow the business. But from then it was a lot easier. Every team member that we've added after the first team member got easier and easier. And now, relatively easily, we can add a team member without it disrupting the business, without concern for the business. We could add one on, but it's that opposite effect of, now we're just trying to make sure we're efficient, not putting bumps on seats.
Yeah, and I'm curious about your mindset because it seems every other day you're bringing new people into the team. And I'm always impressed at your ability to find talent, to hire it, to invest the money. Some of these positions are quite highly paid. And so, how do you approach that investment when you're looking at it as a business, when to bring someone on, the decision making, how you look at that particular employee when you're bringing them in?
There's two parts to this one. So the first part would be, am I going to make him money from employing this person? So whether it's a qualified carpenter maker, cabinet maker, carpenter, boiler maker, something like that, where they're just going to generate you money, they're going to be on the tools making you money, an accountant, bookkeeper, lawyer, whatever it may be. It depends if they're generating you money or if they're going to save you time. When I look at majority of the team members that I've employed over the years, they're going to be accountants, bookkeepers, and they're making me money. So if we hire correctly, or when we hire correctly, they make the organization money. And obviously that's amazing. And then we bring in the support team. So how can I ensure my key players are productive? And then how can I do that? By keep making sure that they're always productive. If they start answering phone calls because people are calling the office, but they're my main billable people, or the guys on site, they're the best tradies, then I want to bring an admin person in to ensure that I protect that time of that person, or protect my time. So going back to the point, we first built a lot of billable team first, and then once we worked out that billable team is getting dragged down by doing admin, we bring in those admin team to support. And I guess one final point on that topic would be, at a certain point when the business is big enough, you then go back to how many hours you work in the business. Most accounting firms in Australia run pretty aggressively on the business owners, where they're working 50, 60 hours a week. And we've always modeled our business, or our accounting firm, not like that. Sometimes I notice that my hours were getting up there to some levels that I wasn't happy with, that 50, 60, 70 hours a week. And once it got around that 70 hours, I'm like, something has to change. This isn't something that I'm going to allow to continue to happen from a long term. Something needs to change, and I need to employ someone to make that change happen. So whether it's another accountant or a practice manager, it just depends on, at that point in time, where was I putting my time?
Yeah, it's a fascinating mindset because I feel a lot of business owners would be feeling like they're in that situation where maybe they're still getting pulled into the technical side. They're doing some long hours and they're looking for a way to create that time freedom, or to at least reprioritize that time. So it's a really powerful insight that you offered there. Now, this is an interesting story because a few years ago, might have been 2 or 3 years ago, you essentially acquired another accounting firm the same size as your own to scale. Share that experience with me. What put that on the radar? Was it something you had planned and thought about? Because it's obviously a very powerful way to scale and grow the size of your business. Talk me through the thought process behind the acquisition.
It was a very turbulent time in business for us. So to set the stage here, we did our first acquisition, $1 million revenue. We were doing $1 million revenue ourselves. So we doubled the business overnight in February 2020. And when we went through this whole planning process of how could we effectively bring in a new team, how can we join our cultures together, bring a new client base in and change our software and our systems to allow for double the amount of people and double the amount of work, we planned it as best we could. And then boom, COVID happened in Melbourne,
Yes.
Australia. And we were the most locked down city of Australia. And that made a lot of challenges. So the first thing was you need to, when you're purchasing a business, whether it's for growth or just to start off in a new business, you got to have a really good plan. And our plan was straight away, we're going to double and have hierarchy. With that hierarchy, with those managers, with that senior level in place, that would allow us to hit the ground running and be able to take certain task away from myself and my wife Jenny, which would allow us to grow the business faster. So we had this in mind of how we would do it and how we would execute it. Unfortunately, it didn't really go to plan. COVID, had a lot to do with it, but also I would say that in hindsight, maybe the purchase wasn't the best decision we made from a financial standpoint. It is what it is, and we learn from it. So would we do another acquisition? It'd be very strategic one, and there'd be a lot of due diligence that would have to go into it to get me to approve something like that. But I'm always interested in buying other businesses that are not accounting firm related. So definitely on other businesses, just probably not so much on the accounting firm.
If someone was looking at an acquisition in that space, would you have any key lessons or takeaways or something to put on the table for them to assist with that decision-making process?
I think it's not accounting firm specific, but really understanding who your current clients are and how you get along with those current clients. And then if you are purchasing another business, whether it's an accounting firm, a plumbing business, Sparky business, it doesn't matter. But if you're purchasing another business, who are those clients? And how are you going to get along with them? Because that was the difference that we found was our client avatar was completely different to the ones that we purchased. And it means that we weren't able to connect as well as what we wanted to. One of my ideas in life or core purposes is to have meaningful connections. And you can't really do that if the people that you're trying to connect with aren't also interested in connecting with a 30-year-old or at the time 28-year-old. With that in mind, I'd just say that when you're purchasing any type of business is to understand the clients that you'll be looking at purchasing, understand what their needs are going to be, and that you are comfortable to help support that type of client.
I think that is another thing to draw on. How is the experience? You're 28 years old at the time, and I'm assuming that a lot of the clients that came in were probably much older, been in business for a long time. How is that integration? Listen, Jenny, your wife is also very young as well. What was that like having these older clients come and speak to you as a 28-year-old through that acquisition?
It's really challenging at that point because when you purchase another business, the clients aren't consenting in a sense for there to be a change, right? So it's not like the clients have come to you because you're an expert in your field. The clients are just happily doing what they were doing, and you are now forcing upon them change. We've had over the years, we've had a lot of clients who are much older than what I've been, and it's never been a problem because they've come and sought our expertise. They might have seen me speak. They might have been referred from someone. They might have, I might have spoken to them on the phone a couple of times, but they've always been wanting our service. Doing that change was when we first purchased this other accounting firm. They just really, a lot of people weren't interested in that change, and they struggled with it a lot of the clients, because straight away we were changing the technology, we were changing the process. And in that case, we changed the people because now it's me and my wife are the main two people. That ruffled some feathers, which was always expected. We had a client leave on day 2 because they didn't want to sign documents electronically. And I'm like, well, I don't really want to make an exception to the rule of signing this type of document electronically because we have to rebuild our whole system. And I'm like, you can always come into the office and do it then. But they decided that, nah, this is too much change, so I'll change accounting firms.
Were there any mental or emotional challenges through that period? How was the experience on a personal level?
In business, we wrap our identities around the business. And that's why I said before, I can purchase another business unemotionally, and I can make those decisions pretty easy. But if I was to purchase another accounting firm, I probably would be very hesitant. And because of that, I look at it and go, even though we hadn't had a chance to prove ourselves, like within 2 days, someone had left the new accounting firm that we purchased. You didn't even have a chance to call them up, or maybe we did, but they would have, they would have received the letters and the emails and all that, and then they'd made a choice to change. But that still hurts, right? That's if you've got your identity attached to the business that you're in and you lose a client, it's going to hurt. And over that first couple months, again, going into lockdowns in Melbourne, but we did lose in dollar figures, probably about $100,000 worth of clients, which was about 10%. And we expected to lose it though. We fully was aware that we would lose 10%. But each time we lost a client, it hurt. And it's trying to separate the emotion. This is business, that they're making a decision based on what they believe is in their best interest, and trying to separate that from they're leaving because they personally don't like myself or Jenny, which could also be the case. But fast forward, we look at it and go, majority of the clients stayed. We have 95, 98% of clients stay with us and continue working with us on year, which is why we continue to grow. Majority of clients are raving fans, which again is why we keep growing. So trying to stay away from a couple emotional decisions that people made at the start and trying to protect yourself from it a little bit. But yeah, it's still a hard period to go through when you do lose clients, especially when you lose quite a few clients at once.
I think anyone that's been on the business path for a while has probably been through a period where you either lose a big contract, a client, even a client that's been with you for a long time. And it is something that can hit home pretty hard. The longer you go down the line of business, the better you're equipped to deal with these scenarios. But it is always confronting and it never feels nice. But there's a pretty awesome transition that takes place in, let's call it, I'd say it was almost 12 months ago, maybe it's a bit sooner, where H&B Group becomes Hatcher Advisory. And I'm on the internet over the weekend, and you're winning awards for the brand through the collaboration with Pixel Palace. And you've really started marketing at a very high level. There's a lot of content going out. The brand's everywhere. There's billboards up in the city. How has that changed the business in the last 12 months?
H&B originally stood for Hotman and Brown, which was my wife's last name and my last name. And at a certain point for us, it became more than our business. And we wanted to create something more than us that the team could be proud of. So we did that rebranding. Pixel Palace led the charge there and supported us throughout that journey. But for us, it's a major cornerstone for us because we were able to bring two brands. GA Partners is the one we purchased, and H&B Accountants. We were able to bring them into one as one united group, united family. That in itself, bring those two brands together, making sure that rewording everything that we did so it's a united front, has profound impact on our business, on our culture. And we've been able to really mold the culture around what we're trying to create here. It's amazing. Like, we have amazing support from different people, which is why in Melbourne we had a couple of billboards up with Hatcher brand on it for a few weeks, which is pretty awesome. That rebranding process is really important because then you can start identifying exactly what you're after as a business and who you want to target. And for us, it was a redefining what that was and who we wanted to go after and who we could support to the highest level. And that's what we now look at, going, well, we can't support everyone under Hatcher, but the ones that we can support and we can bring on, we want to do it to a very high level.
What is the growth strategy to continue scaling Hatcher moving forward?
Here's some IP that we're going to let some big fish out of the bag now. One of the big things that I want to do was to ensure we didn't increase the headcount of our business anymore and just become more efficient. And that would be limited growth. So originally you'd think about that and go, that's limited growth. And I thought about that too. I agreed to my team that we wouldn't increase too much between now and June next year, because we have been working pretty tirelessly over the COVID periods, and the accounting industry did get pushed pretty hard during those lockdowns with the advice that we had to give out to people and the grants we had to apply for. We're kind of resetting, recalibrating right now. And I'm nervous to say it because this will be on the record, but the plans that we have for the future will end up being additional offices and sites all across Australia. And in the future, we look to be in every major city around the country.
You've kind of answered my next question. What is the vision for Hatcher? So it sounds like it's pretty significant, and I've always admired your ability to think and how your brain works in those areas. If you were standing next to Gary Brown, the one that was starting H&B seven years ago, what's that one piece of advice that you would give to Gary Brown 7 years ago?
I think it's that continuous learning. So everything that we do in business has to be an opportunity to learn, whether we do something right or wrong, whether we make a good decision because we priced the job correctly, or we make a poor decision because we've lost a lot of money on a job. I don't think that relates to the accounting firm. I think it relates to every single business. So I think the ability here to learn from your mistakes or to continuously do self-education, because that is the only reason why I'm here, where I am today, is because we've invested hundreds of thousands of dollars into additional education after doing university, after doing my professional trainings, hundreds of thousands over the years into it. And I think that continue to do that. Probably I'd say like started 2 years earlier than what I did, because I started it around year 3 of the business. But if I started it in year 1, I'd be a couple of years further down the track than what I am now. So like working on that self-education.
Great advice, mate. And we're going to pivot into some gold nuggets for the business owners that are tuning in. I'm not sure if we need to put a disclaimer, but if I ask any of these questions and you need to say or heed to maybe seeking some independent advice or whatever it is, I'll let you make that announcement. But you see hundreds of businesses, if not thousands of businesses over the last few years. What are the biggest mistakes business owners make when it comes to their finances and accounting, which is essentially the oxygen of a business? And you could say the financials are the dashboard. What are the big mistakes that you see across the table?
I'm extremely biased because I'm an accountant. So I would say a lack of financial understanding of the numbers. The clients that I work with, the ones that do the best are the ones, for example, the best tradie that I have is one that is amazing at numbers. And it blows my mind, and I'm quite surprised by the stereotypes that we have in this world. But majority of the tradies that I work with have improved their numbers quite substantially from when I first started with them. But the best are really understanding their numbers. It's got to be the key attribute in running a business, is first looking at how much does it cost you to get your product to the market, whether you're charging a per hour rate or a price for a mouse. How much does it actually cost to get it out to the market? How much does it cost to acquire the new customer or sell your product? And what are your overheads per unit per hour? And how many units or per hour do you need to charge per week or sell per week to achieve a profit? The numbers there are critical. And I think and the businesses that perform the best are the ones that understand the numbers and they get the advice around it. If they're not good at it, then they will get the advice. It's like I'm not the best person at marketing, so I pay other people. If you're not the best person at accounting, cool, pay an accountant. There's heaps of them.
I think that's so important because, and one thing I'll speak to is your team is amazing at educating the clients that are willing to learn and understand their balance sheet, to understand different strategies, that ask the questions. They're always got their hand up to come and solve the problem or to help you understand it better. And it makes a tremendous impact on your decision making, is what I've seen, when you can really interpret the financials properly and have the right information. You're kind of going in blind, would you say, if you don't have the data to make accurate decisions for the company?
Absolutely. So leading back on what we're talking about before about buying businesses, someone says to me, "Oh, Gary, I want to buy that cafe." And the only thing I'm interested in understanding is the numbers. So I'm like, show me the financials. Let's see how they're performing. And how did they come up with the purchase price of $1 million? And then there's like most of the time it's all this story and talk about why it's $1 million without the actual factual numbers to back up that type of purchase. And sometimes the numbers don't exist. I can easily see where that doesn't work, where people fall down, where they may buy an investment on the whim of someone selling it to them without actually understanding the numbers properly. One of the first clients that I helped buy a business, they worked in the business for 10 years as the main restaurant manager. And when they showed me the numbers of the business that they were purchasing, both Jenny and I had reservations about paying that much money for the business. He assured us that the numbers were misleading because it was missing a couple $100,000 worth of cash income a year. Cash income should be declared. We said, well, based on the numbers, we wouldn't be able to sign off on that type of deal. He proceeded to buy the restaurant anyway. Unfortunately for him, about 12 months later, went pretty bad for him because he believed that the cash income wasn't in the financials already. But the reality was that the business owner was already banking the cash income. And he had a misunderstanding of how much money the business was taking in per week prior to purchasing it and post purchasing it. And he wasn't able to meet the repayments that he had on his loans. And he was in a pretty tight spot. So like not understanding your financial numbers in every aspect is critical, and definitely not overextending. Whether it be a car loan for 20% interest or purchasing $1 million business, you've got to be well across these numbers so that you don't make a poor decision that lasts a couple of years.
What about protection? So structures, protecting the assets, some of these entities are people's like primary play for their life. What
Yeah.
challenges or what do you see in that aspect when it comes to structuring and protecting their main, I guess, investment in their life?
Every business owner needs to consider their personal assets and their businesses two separate buckets of assets. And realistically, your business should be operating under a trust or a company and away from your personal TFN. So that just in case you own any shares, properties, cars personally, that if something happens under the business, you're less likely to lose those personal assets. So having the right structure in place could protect the house that you live in. We've got to be mindful of the structures in business, even if you don't want to spend the money on the accountant or the lawyer, but you really have to, because sometimes it's too late to change it. The best example I have is with one of my clients in Sydney now. They sold their business for $36 million. They created it 50 years ago and they've hit retirement, which is amazing. Good on them. But the way that they structured the business 50 years ago was under a company. So now that they've sold the business for $36 million, they don't get a 50% discount on the sale of the business because it's under the company and they're not selling the shares in the company. They're selling the quote goodwill. And because of that, they effectively will pay top marginal tax. So instead of paying 23% tax, they're going to pay 47% tax. And you have that conversation with someone who's going to be now paying $15-16 million tax bill instead of an $8 million one, all because of a structure problem that was done 50 years ago that was well before my time.
Millions of dollars just because the structure wasn't the most appropriate for the end goal. And I think maybe you should speak to that a little bit as well. Business owners should ultimately have an end game in mind when they start the business. Is that what you would suggest?
I would always say that what's your exit strategy? So again, we'll be able to find out in 5 or 10 years what happens here for me, or maybe longer. But I always envisioned my business, not necessarily the accounting firm, but my business, whatever that is, to be listed on the stock exchange. I always envisioned that. So when we set up the accounting firm, the vision was we'd have an accounting firm, we'd have financial planning, we'd have mortgage broking, we would do those things, and eventually we would be big enough and would list it on the stock exchange. That was the exit strategy. Time will tell if that ever eventuates, and I'm not quite sure I want to do that from the accounting firm perspective, but time will tell. And I think at the start of every single business, you need to have a goal in mind of what it looks like of when you're either going to exit it or how you're going to get it under management as quickly as possible so that you're not involved in the day-to-day running of it.
Sound advice, mate. And We talk about the ATO. So if you're listening from a non-Australian uh, location, it's the Australian Taxation Office. Are there any red flags that business owners should be aware of that the ATO are looking for with businesses and the way that they're operating and running their financials?
The ATO does a lot of audits around individual tax returns. So people that are operating as a sole trader, and they look at it and go, you only achieved $50,000 worth of income this year and your expenses were $40,000, then how did you live? So then, because they're asking that question of how did you live, if you're a tradie, straight away they're like, this guy's doing something dodgy. Did they use an accountant or did they lodge it themselves? It's quite interesting because each week we get tax updates of different cases that are going on between the ATO and the taxpayers of what people are doing. So many times we read and going, God, that was so silly. Why did that taxpayer not have an account and they cannot lodge the tax returns? They never would have let that happen. I always find that it's the individuals that don't want to pay for the advice and they think that they can lodge a tax return without knowing any actual tax laws, then they're the ones that find themselves in trouble later when they've overclaimed on something. And nowadays with data matching, it's very easy for the ATO to pull people up on their tax returns for not having the right stuff inside it. And if you look at cryptocurrency, it was always talked about as being an untraceable transaction. That was one of the key points. And now when we do tax returns, the ATO tells me if you've had crypto sales for something that was untraceable. I think there's a lot of red flags there. There's also on cryptocurrency, there's a lot of red flags getting raised by the ATO on cryptocurrency. So again, the data matching is phenomenal in this space. You can pretty much guarantee that if you have some questionable stuff going on and you've got cryptocurrency, that you will likely have an audit.
So if you're a business owner, what are some of the efficient ways you're making profit, you start making some money to pay yourself?
What I've always done in my business, and I always tell my clients to do, is to withdraw a wage that is equal to the lifestyle. So if your lifestyle is costing $1,000 a week, then you want to take out a wage of a net $1,000, so probably $1,280 less tax. I think that one comes at around $1,000 net. Hopefully nobody fact checks me on that one. And if they do and I get it right, please comment on
Yes.
wherever you're listening to this on. Look, I would start off with that because what I want to do and what we've always done in our business is we've always looked at how much money do we need to live our life. Then that's our first objective. Once we achieve that objective, we let the business build up the money, which allows us then to invest in new software, in new systems, in new team members, which allows us to grow the pot bigger. But if we take it all out and spend it on jet skis, boats, lifestyles, we're not going to be able to grow the business as much. And I would never have been able to build the wealth that Jenny and I have been able to build without keeping that money inside the business to then later take it out as a dividend, as a loan, depending on the entity that you may have, but take the money out to invest it elsewhere later. So I think for me, if I was advising a client, I first start off with just take out the bare minimum. What do you need for your lifestyle to cover your holidays so that you're never withdrawing money during the year? Let's start off with that as a stepping stone. Once you've worked that number out, everything else above it doesn't mean you go buy a jet ski. It means you buy investment properties, you buy shares, you expand your business, and you grow to the point where you don't have to make financial decisions for the business based on a need for income. You're able to make those financial decisions based on your purpose, and the financial consequences don't matter.
Yeah, I can speak for myself. There's been times in my business career where I've taken more money out of the business than I should have. Just having a strategy or plan that you stick to for that is a great way to scale. So when people in the later stages of their business career, when they either want to exit or retire, what are some of the challenges that you see when people get to that stage as business owners, or the mistakes that they make that have put them in a sort of a compromising position at that part of the journey?
And I think we can talk about this from the opposite side first, which is from a buying side. So if you're going to go buy a business, the first question anyone would ask for is, can I see the financials? And when you look at the financials and if they're not equaling to what you think they should be for that type of business, and the agent will go, oh yeah, but he pays his car loan and he puts a lot of expenses through the business that is personal and blah blah blah. He takes a lot of cash income and all these justifications of why the business profit is XYZ, but they're trying to sell the business for $2 million, but the business profit is only 300 grand, and there's no justification for you that you could come up with to buy that type of business for that type of valuation. So I think when you're looking at exiting a business or you're thinking about retirement, if your retirement is your business, if all your assets are that business and that's all you have, then you need to make it as attractive as possible 2 years prior to you wanting to exit it. I personally, I don't want to have 40 years of running a business to have everything riding on the last 2 years. And what happens if COVID happened? This is where we go back to what I was talking about before, is if you set yourself a wage and you don't spend more than that wage and you were to invest money over that 10, 20, 30, 40 year period, you would have other assets. And that means that you wouldn't be reliant on extracting the exact amount of money that you need for your retirement. And we see a lot of people selling businesses at around that 60, 70 mark, and they're selling the business because they think they need $1 million to live off. So they're selling the business for $1 million. This is worth 200 grand. No one's going to buy it. And they get really upset because they've pulled this arbitrary number out of thin air, because that's what they need to pay off their mortgage, pay off this, pay off that, pay off that. They need $1 million. So I would say that it takes 2 years to get your business in a position to sell it if you want to get the best value. That for that 2 years, it needs to be run like a lean machine and making a lot of money, and you'll get a really good valuation on it. Besides doing that, don't put yourself in a position where your only asset is the business, because that's where, if something happens out of your control, you don't want everything riding on it.
I think probably good if we reverse engineer back to the start. So anyone that's sort of in that early stage of business that's hearing this conversation, what would be a couple of tips or considerations to put in place from day one so you don't run into that challenge in the future where it might be your only asset and the valuation that you're anticipating isn't the one the market's going to pay for it? Are there a couple of like 2 or 3 things that you would say would put you in good stead to be prepared for later in life?
The thing that Jenny and I did that worked the best for us was, at the time when we started the business, or my last employment, was I was getting $1,000 net into my bank account on wages. That was the last time I was employed. Jenny was getting more than that. She was able to bring her personal costs down to that $1,000 level. For 6 years, we paid ourselves $1,000 a week, and that's what we spent on lifestyle. And that's how we built our assets. I have more investment income per year than I drive for my accounting firm. And that was only ever possible by investing substantially more money over the years than what I was taking out on lifestyle. And if you're starting off business or you're at the start of a business, you've got to really fight the urge of overspending just because you have the money there. Just because you can buy a jet ski for 20 grand doesn't mean you go buy a jet ski for 20 grand. Names don't need to be mentioned, but everyone that I know who has bought a jet ski has sold it like 2 years later, and because they only used it 3 times.
Interesting. And on that note, one to wrap up for the business owners, besides the great advice, don't buy jet skis early on in the journey. Are there any little tax efficiency tips that are low hanging that are worth sharing that come to mind for business owners?
The main one here is, if you spend money in your business to generate income, then that's going to be a tax deduction. That's all you have to think about. If you physically spend money, then it's going to be a tax deduction. If you don't spend money, it's really hard to say that you incurred some type of cost, and there'll be some stuff that you'll be able to claim that relate to where you live. But majority of the time, I just look at this and go, it's simple as buy an asset like a car. We can depreciate it over a couple of years. Right now, we can do it in 1 year. We can reduce the tax that you paid this year. But we don't want to do those type of investments, or buying a truck or something like that, where the only sole purpose is to reduce tax. Because if we're spending $100,000 to reduce your $30,000 tax bill to zero, you're still spending 70 grand. Whereas
Mm.
I was spending that 70 grand on buying investment properties and buying shares and turning that 70 grand into $1 million.
Which is really exciting to the next topic of conversation. You only turned 30 a few months ago. Your investment track record and the portfolio you've amassed by the age of 30, most people will never get anywhere near that in their lifetime. When did you buy your first investment property?
Just before I started the accounting firm, I believe it was the first investment property that I purchased. So that property was in Phillip Island. At that time, it was $315,000 to purchase it. I spent around $30,000 cash and the rest was borrowed. More recently, again, history will say if I was right or wrong with this decision, but I sold it more recently after doing some work on the property for just under $700,000. So we made quite a sizable amount of money on that investment decision, enough to buy my dream car in cash. So $30,000 into an investment property. The investment property does well over that 5, 6, 7 year period. Now I could buy the dream car in cash, which is interesting. A red Ferrari, California Ferrari, for those that like cars. And my wife, Jenny, she signed off on it. She's like, yeah, you can buy it now. It was really interesting and fascinating because I still don't want it yet. I want the car. I'm just not ready to buy it yet. I've got other things that are more important for me to invest that money into to make more money. And the car's not one of them just yet.
So, what is your mindset around investing? Because to get to 12 properties in your 20s, that requires a very different mindset to the general population, probably to 99.9% of the population. How does your mind work when it comes to investing and having the discipline to take capital profits and pour them into growing your wealth?
It's an understanding the compounding effect here, that buying one investment property, it goes up a little bit, gives you the confidence to buy the second one, the third one, and so forth. But a lot of people won't tell you this, that you can't just leverage and leverage and leverage. You need to have the income to support the lending. And it's not like we went out and bought $1,200,000 properties. The cheapest property was that one in Phillip Island for 315. The rest of them were above 500,000. So we were doing sizable or average properties. And the only way we were able to do those purchases was because we had a strong business, and we have a strong business which allowed us to borrow the money. When we had these gains happen in these properties, we were then able to use the bank's money to re-leverage and go again. Knowing when to do that in the right type of properties, the right type of the property cycle is important. And like right now with rising interest rates, probably not the best time to be leveraging as much as possible. Probably the time where you want to be exiting out of properties that you're overexposed in, that have low rental yields, and holding cash so that you can buy into properties when we have interest rates come back down.
What's your criteria for buying an investment property, given that you've made that decision several times over? What do you look for?
In this case, I trust my experts, and my experts, they're normally, I think I bought 5, maybe 7 properties through one person or one company, and all of those ones I've done exceptionally well off. But I like to say trust experts. But if it was just me and it's just me picking the properties, I think about it as, is there a supply and demand for that area? So are you near water? Are you buying an apartment in CBD of Melbourne where there's 20,000 apartment approvals a year? Does that mean that the apartment values are going to go up? Probably not. Are you buying in a coastal town that they've got limited supply of land, which means that the council's releasing limited land for subdivisions, which means that house prices are going to go up? So for me, I want to buy near water or a park, school zone that there's limited supply, and I want land. So every property that we've done that we didn't have land, we haven't done so well on. So we bought an apartment in Brisbane, or my wife bought an apartment in Brisbane, and I will be mindful of what I say. She will listen to this later. And that apartment hasn't gone up in value in 8 or 9 years that we've owned it. So I would say that all the reasons that person sold my wife on the apartment never eventuated for the reasons that they said it was going to. For me, I'm like, if there's water, there's water. If you're 500 meters away from a beach, nobody's going to not build the beach. In 10 years' time, you're still 500 meters away from the water. Whereas if you're building, like if you're going to buy an apartment in a CBD area, then what's stopping them bulldozing the next four houses down the road and building another apartment with another 2,000 apartments in there? I'm looking at that scarcity. What's going to improve? What's the reason for me to, do I want to live there myself? Would I want to live there myself? If it's purely investment reasons, I'm always big on the income factor. I always want a property to have 5-6% rental yields as a minimum. For the listeners out there that have been buying in CBD of Melbourne or just Melbourne in general, you're probably looking at 2-3% rental yields. Doesn't mean that I'm right and they're terrible investments, because we all know Melbourne's gone up a lot in the last 10 years. But the properties that I'm buying would have 6, 7, 8% rental yields and sometimes over 10. It means I'm not heavily reliant on the capital growth. So if it takes another 5 or 10 years for that hospital to be built, which is why I bought in that area, I'm still getting really good rental yield in the meantime. And once that hospital is being built and it's finished in Bundaberg, my house prices went up. I think it was up 40% or something. As long as you have those strong rental yields for those investment properties, it doesn't matter what the cycle happens, because you're never forced to sell it. So right now we're exiting out of some of our properties that have low rental yields, and we're going to buy into ones that have much higher rental yields, because that's where I think the market's currently at. You've just got to weigh up your own personal circumstances, whether you can hold on to a property in a rising interest rate market, hold on to that property and get through it. Because we've seen clients after the fact, we've seen clients buy properties, sell them because they thought that they couldn't meet the loan repayments, and then be left with a personal loan, because that's what happens if you've got money left over and you haven't paid off your bank loan, for more money than what they were out of pocket originally. So we've seen some terrible things happen there, and I never personally want to be forced to sell a property. So if anything changes in my business, we can keep all of our properties. I've always been with that mindset, is that I never want to be personally forced to sell an asset. I want to sell the asset when it's the right time for me to sell it, not when the market deems it or the conditions change and I'm forced to sell it because of something out of my control. I'd say that everyone should be mindful of that. You never want to be forced to sell it because interest rates have gone up to 8% and you can't afford it anymore. That's just poor planning. The properties that I want to own, if interest rates go up to 8%, it's going to suck so much, but I'll be able to hold on to it. And likewise, I'll be able to use my cash or my funds that those properties make to buy more properties at 8%. So when it goes back down to 2%, I've just doubled my wealth.
Very good sharing of one, your expertise, and also the way that you look at that market. It's unique to be able to get the insight from someone that is got the runs on the board, is not just talking about this theoretically, but does this and has done it very well. If there was one simple strategy for the average person to consider when it comes to, say, property or some investment vehicle, do you have any like pointers or a tip? If you just did this one or two things, you'll put yourself in a reasonable position down the track?
I would say be patient. If property is selling like hotcakes, it's probably not the right time to buy. If we're talking you're only ever going to buy one investment property and that's it, pick water. Go anywhere that's walking distance to a beach, 500 meters, a kilometer, that type of range. Pick that and you'll be fine. The easiest way to make money in this country is to buy near water. So don't overcomplicate it. Don't worry about it if the house is a terrible house and it needs to be ripped down in 10 years. So be it. I'd say pick near water. Make sure you maintain it, obviously, because someone's got to live there, and be patient.
I love that advice, that takeaway of consider buying near the water based on some of the fundamental reasons that you just mentioned. We'll pivot slightly again onto something that's more recent in your world, but very exciting. So you started a steel company. How does that come about?
When people complain to me about suppliers, previously I wasn't in a position to do much, but if people kept complaining to me about certain suppliers, so structural steel, for example, and at a certain point I was like, can't be that hard. Set up a structural steel business, do it to a level that everyone's happy, and to make money at the same time. So then I went off into the journey of finding out it is freaking hard. It's not easy. Cost a lot of money, several hundreds of thousands down. We bought a factory. We employ several people. We have some really, really great customers and builders that we work with now. And we're making sure that the system and the process is right. But I now get to do this from a second lens of I'm making unemotional decisions about what we need to do. It's like, okay, we need to buy that a piece of equipment, but that piece of equipment is going to cost 20 grand. How much money is it going to make me? Or how much time is it going to save me? I'm not just spending 20 grand because you want me to spend 20 grand. I need to understand the facts here. It's a little bit different. We're trying to drive as much profit out of that business as possible. And we're able to do that because I go back to the builders, find out what their pain points are, and we're just trying to resolve those pain points. If they're stuck that their structural steel guys are taking 4 weeks or 6 weeks or take a week, 2 weeks to come back and fix the defects, then we're just beating it. I'm just putting more boots on the ground to make sure that we are better. That way we've been able to win more work, and we've been able to win more work. We've been able to manage the costs pretty well, and we've been able to look for efficiencies. But it's early days, and we have some really cool things that we're trying to do over the next 12 to 18 months in that business. We just found a gap in the market that we thought we could do it better. And with my trade-based background, kind of understand it pretty well. And we just look at those pain points and how can we debrief it? How can we make sure that we're not causing those pain points? And how can we just be the best structural steel business in Melbourne?
Going through the startup journey again, what's your top tip for anyone at that startup phase?
Because it was such a heavy investment of physical cash, pretty much everything we bought brand new. I didn't really want to buy any pieces of equipment secondhand, so I wanted everything brand new. And I think the cash flow implications of that. So for us, we had an understanding of what date did we purchase the factory that we moved in? What date do we settle on that? When can we start making income to pay the bills? And we forecasted all that out like a good accountant does. And it actually, stuff happened and it didn't go to plan. And we had the resources to continue to fund what we needed to fund when it didn't go to plan. So understanding the financial numbers, having it mapped out, and making sure that you're not desperate in your cash, because if you go into it and you're just scraping by, you'll get eaten up in business. 95% of businesses fail. And I attribute that to a lack of cash to start the business and a lack of experts around those people.
What's the vision for the steel company moving forward?
I've not put as much effort into this one as my accounting firm in that sense. For me, it is just to make a bucket load of money. So probably not the best vision. I will reflect on this one later. I think the reality here is that we just want to make money and do it in an ethical way. Sometimes we give builders pretty big discounts because we're going to work with them for the next 5-10 years. And they understand, I tell them what our pricing is, and they understand our pricing. We understand their pricing. We meet halfway in the middle, and it works for both parties. And then they're able to give us $2 million worth of work. And because we have that massive amount of work, our overheads aren't so scary. And then we might be running a tight ship on 5-10% profit margins, but we're able to get a $2 million contract, get another $2 million contract, get another $2 million contract. And scaling the business is a lot simpler then, because we're giving back. We're doing agreements with different builders, and we're going, okay, well, you're currently paying $20 a meter. We can get it down to $18 a meter, but only if you give us XYZ amount of money. So the vision for it is make a lot of money, have the least amount of problems. I don't like problems, so resolve as much problems as we can. And at some point in time, it will just keep working by itself because we just keep employing the right people in the right seat. And that isn't me. I'm happy to employ the other people to do the job better than what I can, because I'm not good at any of that business.
Great call. And in some ways, not being a technician is one of the better business strategies, because you can't get pulled in and get on the tools. You're forced to be that true business owner. So I think that's another great takeaway. So, mate, you're doing incredible things. You're only 30 years old. You got a lot of life ahead of you. So what does the future look like for Gary Brown?
I think over the next probably 12, 18 months, we're having a little bit of a shift in our business like we talked about before. So for me, I'm shifting more towards making sure that I'm not committing more than 40 hours a week working. So I'm hitting under under that so I can be at home and spend time with my wife and with my newborn child. So I'm just trying to make sure that it is less than 40 hours and trying to be a little bit more family orientated because previously I've worked any amount of hours that was required. And, just grow on a different level, whether it be being invited onto an amazing podcast like this or guest speaking, trying to impact more people than what I have been able to impact in my accounting firm. So trying to impact on that one-to-many model and getting out there and helping support other business owners through hopefully this and other people aspiring to be business owners or just people in general, just helping them make better financial decisions.
If you could leave the audience with just one piece of advice that to take with them, what would that piece of advice be?
I think it doesn't matter what stage you are in life or if you're an employee, business owner, or just investor, but surrounding yourself with the right experts is the best way that you're going to achieve your outcome that you're trying to achieve. So find those right experts, surround yourself with them, whether it's paying them or just being friends with them. Surround yourself with those experts and you'll be able to achieve your goals.
Amen to that. And if someone's listened this deep into the episode, I'm sure they're curious about how they can get in touch with you, maybe how they can get in touch with Hatcher if they're looking for support there. What's the best next step if they wanted to reach out to Gary Brown or they wanted to get in touch with Hatcher?
Jumping on our website, www.hatcher.com.au, following the prompts there to connect or sending an email to contact@hatcher.com.au. Myself or one of the team will be able to respond back to you and support. And sometimes it's just a conversation about how they can do things better. And it doesn't mean that we come on as the accountant. We're here to support as many people as we can. Whether we get paid for it or not, we're still here to help.
I can certainly vouch for the quality that Hatcher delivers. Just for context, Gary and Hatcher manage all our entities. My wife has business. I have a couple of businesses, one that I run with my wife. We also have our investments and our trusts all under the expert advice and guidance of Gary and his team. They've certainly revolutionized our companies, our structures, our financials, and we're in the best shape we've ever been in. So thank you for that, mate. We're super grateful for you to give up your time, especially that you're looking to get back to those 40-hour work weeks. And I know that we're both here in our evenings and we've got little ones, wives and bubbers to get back to. If you've got this far into the episode, make sure you're following. We're going to have regular guests like Gary that are experts in either the field of marketing, business or wealth. Sometimes you get one that's both, like Gary here today with the business and wealth areas. If you can leave us a review, we'd really appreciate that. It's going to help us build an audience and work our way up some of those different channels that the podcast is on. Mate, thank you so much. I really appreciate your time.
No worries. And thanks everyone for listening.